How can a software company become the backbone of global business? In today's digital economy, data is the lifeblood, and the systems that manage it are the hidden engines powering industries worldwide. Oracle began as a pioneer in database technology, helping organizations store and manage information with unmatched reliability. Over the decades, it has transformed into a cloud powerhouse, offering enterprise solutions that run everything from financial systems to supply chains. Today, Oracle stands as both a guardian of legacy data and a challenger in the fast-moving cloud arena. Oracle was founded in 1977 by Larry Ellison and his partners, with a bold vision to build a relational database system that could transform how organizations store and manage information. At a time when data was scattered and difficult to control, Oracle introduced a powerful solution that quickly became the backbone of enterprise computing. Through the 1980s and 1990s, Oracle established itself as the global leader in database technology, powering banks, governments, and corporations with reliable systems that ensured data integrity and scalability. The company's focus on innovation in database software made it a trusted partner for mission-critical operations. Today, while Oracle has expanded into cloud infrastructure and enterprise applications, its identity as a database pioneer remains central. The Oracle database continues to be one of the most widely used and respected platforms in the world, a foundation upon which modern businesses build their digital strategies. Oracle's business model is built on providing mission-critical technology that enterprises cannot live without. At its core, Oracle offers three major pillars of value. The first pillar of Oracle's business model is cloud infrastructure. Oracle Cloud Infrastructure, or OCI, provides computing power, storage, and networking services that allow companies to run their most demanding workloads. Unlike traditional competitors such as Amazon Web Services and Microsoft Azure, OCI positions itself as a cost-effective alternative. It emphasizes performance at lower costs, appealing to enterprises that want reliable cloud solutions without overspending. Oracle has also invested heavily in specialized offerings, such as high-performance computing for artificial intelligence, advanced analytics, and secure environments for industries like healthcare and finance. This focus on affordability and industry-specific solutions makes OCI an attractive choice for organizations that need both speed and trust. In essence, OCI is Oracle's bet on the future, a platform designed to help businesses modernize, migrate from legacy systems, and compete in a digital-first world. The second pillar of Oracle's business model is database and software licensing. Oracle has long been recognized as the global leader in database technology, a reputation built over decades of innovation. Customers around the world rely on Oracle Database to store, secure, and process their most critical information. From banks and governments to multinational corporations, Oracle's database systems are trusted for their reliability, scalability, and advanced security features. Revenue in this segment comes from licenses and subscriptions. Enterprises pay to access Oracle's software, and many choose long-term contracts that ensure recurring income for the company. This subscription model provides financial stability and reflects Oracle's heritage as a pioneer in enterprise data management. Even as the company expands into cloud services, the Oracle database remains the backbone of its business. It is not just a product, it is the foundation upon which Oracle built its global reputation, and it continues to be one of the most widely used platforms in the world. The third pillar of Oracle's business model is enterprise applications. These are powerful software suites that help organizations run their daily operations with efficiency and control. Oracle's Enterprise Resource Planning (ERP) systems manage financials, procurement, and project planning, giving companies a single source of truth for their business performance. Its Human Capital Management (HCM) solutions streamline HR processes, from recruitment and payroll to employee engagement, ensuring that people remain at the center of enterprise success. Meanwhile, supply chain management, SCM, applications help businesses coordinate logistics, inventory, and production, making global operations more resilient and responsive. What makes these applications so valuable is their deep integration into corporate workflows. Once a company adopts Oracle's ERP or HCM, switching to another provider becomes costly and disruptive. This creates long-term customer relationships and high switching costs, securing Oracle's place inside the world's largest enterprises. In short, Oracle's enterprise applications are not just tools, they are embedded systems that shape how modern organizations operate, compete, and grow. Now we are looking at a small portion of Oracle's financial report for fiscal year 2025 and 2024. In fiscal year 2025, Oracle reported a gross margin of 70.51%. This shows that the company still enjoys high profitability, but margins have compressed due to the scaling costs of cloud infrastructure and the integration of Cerner. In practical terms, Oracle retained about 70 cents of gross profit for every dollar of sales, leaving the remaining 30 cents to cover operating expenses, interest, and taxes. By comparison, in fiscal year 2024, Oracle achieved a higher gross margin of 71.41%. This reflected greater efficiency in managing costs and stronger contributions from software licensing and enterprise applications. In that year, Oracle retained nearly 71 cents per dollar of sales, giving the company more cushion to service debt and return value to shareholders. The decline from 71.41% to 70.51% highlights the financial impact of Oracle's expansion strategy. Yet, margins above 70% remain strong for a software-driven business model, underscoring Oracle's ability to generate consistent profitability even in the face of rising costs. In fiscal year 2025, Oracle recorded a return on invested capital of 13.7%. This means that for every dollar of capital invested, the company generated about 13 cents in net operating profit after tax. While this level of return is solid and reflects Oracle's ability to create value from its investments, it is slightly lower than the previous year. In fiscal year 2024, Oracle's ROIC stood at 14.1%. The higher figure indicates that Oracle was more efficient in turning invested capital into profits, supported by stronger contributions from its software licensing and enterprise applications. The decline from 14.10% to 13.70% suggests that the company's recent expansion strategies, including acquisitions and cloud infrastructure investments, have temporarily reduced efficiency. However, maintaining ROIC above 13% demonstrates that Oracle continues to deliver attractive returns compared to many peers in the technology sector. In fiscal year 2025, Oracle's free cash flow margin dropped sharply to just 1.93%. This means that after covering operating and capital expenses, the company retained less than 2 cents of free cash flow for every dollar of revenue. Such a low margin reflects the heavy financial burden of acquisitions and higher debt servicing, leaving Oracle with limited flexibility compared to prior years. By contrast, in fiscal year 2024, Oracle's free cash flow margin was a much stronger 23.23%. At that level, the company retained nearly 23 cents of free cash flow per dollar of revenue, providing ample room to fund share buybacks, dividends, and strategic investments. The decline from 23.23% to 1.93% highlights the significant impact of Oracle's expansion strategy and debt load. While the company remains profitable at the operating level, its ability to generate free cash flow has been temporarily constrained, a factor investors must watch closely. In fiscal year 2025, Oracle's interest coverage ratio stood at 4.9 times. This means that the company's operating income was nearly 5 times greater than its interest expenses, showing that Oracle can comfortably meet its debt obligations, even though the margin of safety has narrowed compared to the previous year. In fiscal year 2024, the interest coverage ratio was stronger at 5.2 times. At that level, Oracle had more flexibility, with operating income covering interest costs more easily, reflecting a healthier debt servicing capacity. The decline from 5.2 times to 4.9 times highlights the impact of higher debt levels and rising interest expenses following acquisitions. While the ratio remains above the generally safe threshold of 3 times, the downward trend signals that Oracle must carefully manage its leverage to maintain financial strength. Looking ahead, Oracle has several positive catalysts that strengthen its long-term growth story. First, the company is experiencing explosive cloud revenue growth. In recent quarters, Oracle's cloud infrastructure services grew at double-digit rates, with infrastructure as a service expanding rapidly and multi-cloud database adoption rising more than 5-fold. This momentum shows that Oracle is successfully competing in the cloud market against larger rivals. Second, Oracle has built a record-breaking backlog of contracts, with remaining performance obligations reaching hundreds of billions of dollars. This backlog provides visibility into future revenue streams and ensures financial stability, giving investors confidence in Oracle's long-term outlook. Third, Oracle is positioning itself as a key player in the generative AI era. By investing heavily in specialized data centers and AI infrastructure, Oracle is becoming the landlord of AI workloads, offering enterprises secure and cost-effective environments to run advanced applications. Together, these catalysts highlight Oracle's transformation from a traditional database giant into a modern cloud and AI infrastructure powerhouse. Despite short-term challenges, these strategic moves set the stage for sustainable growth and shareholder value creation. While Oracle's growth story is compelling, there are several risks that investors must keep in mind. First, Oracle faces intense competition from cloud giants such as Amazon Web Services, Microsoft Azure, and Google Cloud. These rivals not only dominate market share but also invest aggressively in AI and infrastructure, making it challenging for Oracle to expand rapidly. Second, the company's debt burden has increased significantly following acquisitions like Cerner. Rising interest expenses and lower free cash flow margins limit Oracle's financial flexibility, and any further increase in borrowing costs could pressure profitability. Third, Oracle's execution risk is substantial. The company is investing billions into AI-focused data centers, but delivering on these commitments requires flawless execution. Delays, cost overruns, or technological missteps could weaken investor confidence. Finally, Oracle's restructuring efforts, including workforce reductions, may create short-term disruption. While these moves aim to streamline operations, they also carry risks of slowing innovation or impacting employee morale. Taken together, these risks highlight that Oracle's transformation into a cloud and AI powerhouse is promising but not without challenges. Investors must weigh the company's strong catalysts against the competitive and financial pressures it faces. Now we are looking at Oracle's valuation, where its fair value is estimated at $145.31. If we compare this with Oracle's closing price on April 10, 2026, the stock is trading below its fair value. In the long term, Oracle may face pressure, primarily driven by heavy investments in AI and cloud sectors, which have pushed its debt-to-equity ratio above 200%. On the other hand, geopolitical factors also contribute to negative sentiment. Investors are advised to remain prudent in making decisions. Subscribe for more educational market insights. Thanks for watching, see you in the next video.